912 words, within the 900-word target range, 5% tolerance. Here's the final script. In 1982, the Securities and Exchange Commission drew a line most Americans never saw being drawn. On one side sat hedge funds, private equity, venture capital, the investments that quietly built the great fortunes of the last half-century. On the other side sat mutual funds, savings bonds, and whatever was left in a checking account. No regulator has ever fully explained why the exact dollar figure that decided which side you landed on stayed frozen for the next 40 years. By the end of this, you'll understand exactly what that number was built to protect. The rule is called Regulation D. It created a category of investor the law calls accredited. To qualify, you needed a net worth over $1 million, not counting your house, or an income over $200,000 a year alone or $300,000 with a spouse. It sounds like paperwork filed away in Washington. It sounds boring even. It was signed quietly, filed under investor protection, and barely covered by the press. Most people who were locked out of the deals it governed never even learned the deals existed in the first place. Here's what protection actually did. Once you crossed that line, an entire universe of investing opened up. Private companies before they ever touched a public exchange. Real estate funds reserved for institutions. Hedge fund strategies that outperformed the stock market for decades, compounding quietly, available only to a list of names the SEC had already pre-approved as safe to gamble. Below the line, none of it was illegal to want. It was illegal to be offered. A retail investor with $40,000 saved could not legally buy in, no matter how much research they'd done, no matter how well they understood the risk. The law didn't ask if you were smart. It asked what you were worth. The official explanation was simple. These investments were too risky for ordinary people, and the wealthy could better absorb a loss. That sounds almost reasonable until you look at what the rule actually measured. Net worth and income don't measure financial literacy. A retired schoolteacher with a paid-off house could clear $1 million and qualify. A hedge fund analyst renting an apartment in his 20s, reading prospectuses for a living, could not. The rule wasn't sorting the informed from the uninformed. It was sorting the rich from everyone else and calling it caution. Now here's the detail almost nobody remembers to ask about. Those thresholds, the $1 million, the $200,000, were set in 1982 and never adjusted for inflation. Not once. Not through the boom of the 90s. Not through 2008. Not through a decade where the cost of everything else in American life kept climbing. A dollar amount that once excluded roughly the top 1 to 2% of households had, by simple erosion, started sweeping in millions more ordinary Americans without the SEC changing a single word of the actual rule. The bar didn't move. The ground underneath it did, and the people it swept in weren't gaining access to genius-level opportunities. They were gaining access to risk their savings couldn't necessarily survive. While the truly wealthy had long since moved on to even more exclusive, less regulated tiers the public still doesn't have a name for, tiers with minimums most families will never save in a lifetime. A 2019 SEC study estimated that by then, roughly 13% of American households technically qualified as accredited, a number that had crept upward for years without a single hearing on whether the definition still meant what it meant in 1982. When the SEC finally amended the rule in 2020, it didn't lower the dollar thresholds at all. It added new paths in professional licenses, certain job titles, while leaving the wealth test exactly where it had been for 38 years. The frozen number stayed frozen, untouched through 4 decades of hearings on nearly everything else. Think back to that line drawn in 1982. It was never really about risk. It was about which side of the paperwork the money started on, and which side it was allowed to compound on, quietly, year after year, while nobody outside the club was told the compounding was even happening. Who benefited from 40 years of silence on this? Private funds got a captive, wealthy client base with no obligation to compete for smaller investors, no pressure to lower fees, no public disclosure requirements retail mutual funds are bound by. Wealthy families got compounding returns their children would inherit as a head start, invisible to anyone outside the club. And the middle class got told, gently and repeatedly, that this was for their own good, that they were being protected from themselves, by a number nobody in Washington could quite explain the origin of when journalists finally asked. The pattern repeats everywhere access hides behind the language of safety. The gate is never labeled a gate, and the people it keeps out rarely learn the gate was there at all. So ask yourself the question the SEC has never had to answer out loud. If the real risk were financial literacy, the rule would test knowledge. It tests only money, which means the wall was never built to keep out the unqualified. It was built to keep out everyone who hadn't already made it, and it's still standing today, exactly where they left it in 1982.